What's up, my friend? A little bit formal today because I'm here to share with you on my investment thesis as to why you should focus your attention and resources towards investing in Asia. The title of this presentation is what you need to know about the Asian century and how you can grow your wealth by capturing the growth of Asia. Pretty self-explanatory. Without further ado, let us get started. Here are the standard disclosures. Though I would like to highlight that as I'll be explaining my analysis in layman terms, we will be focusing more on the logic behind the analysis and the thesis as opposed to the theoretical integrity. Now, the whole presentation will be broken down into 4 different parts. Okay, and we'll start off by drawing boundaries as to what is included and what is excluded for the purpose of this presentation when it comes to the countries within Asia. As Asia is a huge continent that includes a wide range of countries and could be split into different parts, mainly Northern, Central, Eastern, Southern, and Southeast Asia, there is a need for us to narrow our scope for the analysis as each part of Asia exhibits different behavior, and it is not fair for us to cast a blanket statement across the different parts of Asia. For the purpose of this analysis, we are only interested in the Eastern, Southern, and Southeast Asia as they exhibit similar characteristics and are structurally positioned for growth in the next 10 to 20 years as opposed to your Northern, Central, or even Western Asia. With that out of the way, let us move on to the second part of this presentation. The second part of this presentation forms up the bulk of my investment thesis, and I'll show and explain to you on the significance of the drivers of economic growth that Asia will experience in the next 10 to 20 years. For this presentation, I'll be using the gross domestic product indicator to explain my investment thesis and show you where the growth drivers are at and how these drivers will contribute to our investment success. For those of you who are not aware, GDP stands for gross domestic product, and it essentially measures an economic's output or production. GDP is an accurate indicator of the size of an economy, and the GDP growth rate is probably the best single indicator of economic growth. The real reason as to why GDP is important to us as investors is because a strong economy will contribute to higher business success. And since we are investing in these businesses, the greater the prosperity in the businesses that we invest in, the higher our investment returns will be, right? Moving on. If you were to break down the key components that forms up the GDP of an economy, it will be a combination of 2 components, right? The population of an economy multiplied by its productivity. If we were to further break down these 2 components, for population, we are looking at 3 key factors: the population size, as well as the consumption abilities and production capabilities. For productivity, we are looking at another 3 key factors, which is basically the literacy rate, infrastructure, as well as technology adoption and innovation, right? Ultimately, a positive development of each factor will contribute to a positive development of the 2 components, be it population or productivity, which ends up contributing to a higher GDP output and economic growth, vice versa. Okay, so let us examine the prospect of Asia's economy through the lens of each key factors, starting with the population size itself. When it comes to the sheer population size and growth, it is of no surprise that the continents that contribute to the growth comes predominantly from both Asia and Africa. In fact, based on the United Nations projection, we can expect Asia to contribute the bulk of the population growth for the next 20 to 30 years before Africa overtakes us, right? By logic, a higher population size would equate to a higher demand for goods and services and higher supply for production, as there are more people to consume and to produce, therefore driving up business activities and growth, which results in greater profitability for businesses. All of this would translate to higher profitability for businesses that serves the needs of this group of growing population. Okay, and since we are investing in businesses, an increase in business profitability will translate to higher investment returns to us as investors. Okay, Now, this logic will only make sense if the population have the spending power to consume goods and services, as well as the necessary skill sets to contribute to the production of an economy. Now, this was also the reason why Asia didn't take off previously, despite accounting for a large portion or proportion of the global population. Unfortunately, even though we had the population size previously, we did not have the spending power necessary or the necessary skill sets to match the high value production. As a result, what you realize is that while we are the global manufacturers of the world, the value that we have created within Asia was not consumed in Asia, neither was it captured within Asia, and it is often exported and captured elsewhere. However, things are changing for the better in Asia as a result of the mega trends that will shape a better future for all of us in Asia. And let me show you what I mean in the next 2 points. Now let us look at the second factor of the population, which is the consumption ability of the population itself. Now when it comes to measuring a population's consumption ability, the key group that we should look at are the middle income class, as they are the group that are responsible for the consumer base that drives productive investments. A strong middle class is also a key factor in encouraging other national as well as societal conditions that leads to growth. Okay? And based on the projections that's provided by Brookings Institution, Asia is set to account for over 65% of a total middle income class across the world by 2030. While I can't find any research and projections for the figures beyond 2030, we can reasonably assume that the trend will continue from 2030 to 2040 as the population size of Asia continues to grow until it reaches its peak at around 2040 to 2050. As you can see, the situation in Asia for the next 20 years is very different from the situation in the last 20 years. While we had experienced a decent amount of growth in Asia over the last 20 years, I would argue that we are nowhere near our peak potential yet, and there are much more room for improvements. Okay? As a society, the people in Asia have become more well-to-do today as compared to where we were in the past, and this will help spur on future consumption and drive more productive investments, which will help further accelerate the regional's growth, of which us as investors will benefit from. Moving on, let us look at the third factor of population, which is the production capability of the population itself. In any given economy, we are always playing the game of balancing between production and consumption, right? Ideally, an economy should produce more than what it consumes, as the surplus can then be used for more productive activities that will generate additional outputs and profits down the road. The problem here is that an economy is dependent on the production and consumption patterns of the people that forms up the economy. And with any given human being, our production capabilities decreases with age, while our consumption patterns tend to remain stable across our lifetime, right? A developed economy faces the issue of an aging population, and they have to deal with the problem as well as the cost of aging as its population starts to consume more than what it produces, right? When that happens, this is what we call a deficit, and it can only be addressed by either drawing down from previous surplus that was generated or relying on future production. To put it in layman terms, as a retiree who do not produce any income, you can either eat into your own savings or you eat into the savings of your children as you rely on their income for your consumption. Okay? As a result of this, the savings that could originally be invested and to generate more money down the road is now being destroyed and consumed thanks to your consumption, right? Now multiply that and see it on the level of an economy. It is to nobody's surprise that an economy that runs on a consistent deficit will not be as productive as an economy that runs on surpluses, right? Basically, an economy that can produce more than it consumes will be richer than an economy that consumes more than it can produce. Okay, let me repeat that. An economy that can produce more than what it consumes will be richer than an economy that consumes more than what it produces. Okay, 2 minus 1 is 1. 1 minus 2 is negative 1. 1 will always be greater than -1. It is just basic math, and as investors, surplus will always be preferred over deficits. Having said that, let's take a look at the projections of the proportion of working population in the different parts of the world to draw inferences on the production capabilities of the given areas. From the chart above, it is evident that the proportion of working population in areas such as Africa and Asia is set to grow, while the proportion of working population in areas like Europe, North America, Australia, and New Zealand are set to shrink. Right? By 2030, we are looking at around 55% of working proportion in Eastern and Southeast Asia, and about 51% in Central and Southern Asia. By 2040, we are looking at about 51% in Eastern and Southeastern Asia, and 53% in Central and Southern Asia, right? Compare that to the figures that you can expect from the developed regions, as well as the sheer population size of each of these regions. We can infer that there will be way more working adults in Asia who are able to produce and contribute to an economy as compared to the developed regions. Now that we've went through all three key factors in the component of population, let us put the findings together and paint a clearer picture. All in all, moving forward, we can expect the overall population size of Asia to continue to grow steadily to 2030 to 2040, of which the increase will be accompanied by an increase in purchasing power of the population, led by an increase in middle income class, while the percentage of working class adults that can produce and contribute to the economy will remain at a steady level. Okay? As a result of this increase in the population size and the increase in purchasing power of the population, what we will experience is an increase in demand for consumption by Asians. Similarly, as the population size increases while the percentage of working class remains stable, it will result in an overall increase in the size of workforce in Asia that will contribute to a higher level of production. The combination of these two factors will result in higher demand being met by higher supply, all happening within Asia. And the significance of this is that moving forward, the value that is created within Asia will start to stay in Asia, thereby spurring a positive feedback loop as the profits and value that was generated in Asia gets recirculated within the economy, which helps further increase the business activities, which then generates more values and profits, which gets recirculated into the economy, and the cycle goes on. Okay, this is very different from what happened to us in the past, whereby the value that was created in Asia gets exported and captured in other parts of the world, thereby leaving nothing much for us to facilitate future development, and the feedback loop was stopped even before it could even begin. Now that we've covered the factors of the population component, let us take a look at the factors of the productivity component, starting off by looking at the literacy rate. The first factor of productivity is the literacy rate of the population, and I think this is pretty much self-explanatory. Education is the key to alleviating poverty. If you can't even read and write, it is very difficult for you to upskill and improve yourself to be more productive and take on a higher income producing job, or even get out of your circumstances, right? While the literacy rate in South Asia isn't at the ideal rate yet, it is evident that the literacy rate as a whole had improved significantly over the years, and this is set to increase further moving forward. That said, we can expect the productivity within Asia to improve as more people are able to read and write, thereby allowing them to improve their situation. Moving on to infrastructure, which is the second factor of productivity. With regards to infrastructure, there are two parts to it, right? Hard infrastructure like your physical building, roads, etc., as well as soft infrastructure like the policies that are in place that support economic activities. With regards to hard infrastructure, urbanization is a key indicator to productivity, as it had been found to correlate with the level of GDP that we experience. Now, looking back, it is not surprising that Asia came a long way in terms of building up our physical infrastructure, and although we are not at the levels of the developed country yet, that just goes to show how much more room we have to grow before we catch up with the developed region. The reason why an increase in urbanization rate will lead to higher productivity within the region is because as cities grow, they bring more people and businesses together, and they also create better transportation system and facilities that provides things like your water, electricity, internet, and etc. Now all of this provides opportunities to the people that's living in the cities in the areas of employment, education, as well as healthcare. Urbanization allows people to match their skill sets with the right job, and the interactions between people and businesses within a city will also facilitate the transfer of skills and knowledge, thereby raising the productivity of the city itself. All in all, it is safe to say that urbanization improves the productivity as people within the city are able to live a healthier life and work better. Moving on to the soft infrastructure, for this part we are looking at the type of systems, the type of institution that a society operates in. When it comes to the type of economic institution and structure, what people often fail to realize is that it is the political process that determines what economic institutions people will live under. And it is the political institutions that determine how this process works. In other words, the type of governance an economy operates in plays a huge role in its long-term success. I mean, just look at Malaysia and compare it with Singapore, right? I think it's pretty self-explanatory. Generally, there are two types of economic institution that people can live under: an inclusive one or an extractive one, right? And inclusive economic institutions are forged on the foundation laid by an inclusive political institution, which makes power broadly distributed in the society. And there are constraints on the exercise of such political powers, right? Inclusive economic institutions creates an inclusive market, which not only give people the freedom to pursue the vocations in life that best suits their talents, but also provide a level playing field that gives them the opportunity to do so. Okay? The focus of any given inclusive economic institution is often on value creation on an economic level. And as a result, an inclusive economic institution often paves the way for two other engines of prosperity: technology and education. And they also welcome creative destructions and innovations. Countries that exhibit inclusive characteristics includes countries like Singapore, Japan, South Korea. On the other hand, extractive economic institutions are often the results of an extractive political institution, where power is concentrated in the hands of a few narrow elite. Okay? And an institution only have a few constraints on the exercise of such political powers. The focus of any given extractive economic institution is often on extracting the value that was created within the economy into the hands of the narrow elite, instead of value creation on an economic level. As a result of this narrow mindset, this group of elites who are in control are often against the idea of value destruction and innovation, right? Or rather creative destruction or innovation, in fear that it will pose a threat towards their political control and economic power, right? Countries that exhibit this type of characteristics are countries like Malaysia, China, Myanmar, North Korea, so on and so forth, right? Now, both economic institutions, be it inclusive or extractive, both of them are able to drive economic growth, right? The real question is if these growths are one that is sustainable. And more often than not, economic growth within an extractive economic institution are not sustainable in the long run. Okay? Today, most developing countries are often operating or are operated under the model of an extractive economic institution. And while there are signs of countries moving towards a more inclusive model, these changes takes time, and these changes are often met with periods of violence and high degree of uncertainty. Okay, For the case of Asia, I personally feel that we are progressing in the right direction in becoming more inclusive on a regional level, though I doubt we'll ever see a day where countries within Asia are fully inclusive, right? A hybrid model will be more likely, at least in the next 10 to 20 years. Nonetheless, the move towards a more inclusive economic institution will be beneficial on a regional level as it helps facilitate a more sustainable economic growth moving forward. And that brings me to the factor, or rather the last factor of productivity, and that is technology adoption and innovation. Over the last decade, Asia has accounted for a large regional share of the global growth in key technology matrix. And though I can't find any evidence of future projections, it is reasonable to assume that Asia will continue to account for a large share of technological advancement in the world. Now, the reason why this is important is because technological improvement enables people, land, and existing capital to be more productive. And it is a huge contributing factor to a sustained economic growth. In other words, technological improvements allow us to do more with less resources, thereby allowing us to create more value and output given a single amount of input, right? In the context of a developed country, technological advancement is the only way for a developed country to pursue further growth, given that most of the economies are already performing or operating at a level that's near full capacity, right? In the context of a developing country, technological advancement is even more significant as it allows for other factors of productivity, like your literacy rate and infrastructure, to improve further and at a faster rate, thereby driving up the pace of economic growth and development, as I would show you as when we put everything together. Now that we've went through all the three key factors in the components of productivity, let us put the findings together to paint a clearer picture. Okay. As literacy rates increases, people become more educated. And when that happens, they start to look for more opportunities to improve their lives and place more emphasis on things like equality and fairness. And as a result of this, people will start to migrate and move to places for better opportunities, and this will spur on the demand for urbanization, as well as the demand for a more inclusive economic institution. Technological adoption, improvements, and innovation will help accelerate the growth and development process in Asia, as people are more connected online and information can be transferred and delivered at a faster pace and at a greater scale, right? This is important because it will contribute to a higher literacy rate, and it will also create an environment, right, that is harder for an exclusive economic institution to thrive in. We can already see this happening in countries within Asia, like for example, Myanmar, Indonesia, Vietnam, as well as Thailand, right? Once again, this creates a feedback loop, which will lead to higher productivity in Asia, as now we are able to bring out the full potential of the people and the resources of the region and maximize the value that can be created given an amount of input. Now that we've went through the factors of population and productivity, I hope you've gained a greater understanding of the structural forces and the mega trends that are already in place to bring Asia to the next level. In fact, Asia is expected to contribute about 50% of the global economy, and as investors, if you are looking for growth, you have to participate in the growth that Asia will be delivering in the next 10 to 20 years. Okay? Investing solely in the developed regions like North America and Europe will provide you with the stability that you may want to have, but it will not provide you with the growth that you need to accelerate your wealth accumulation progress. Now that we've understood the upside that comes along with investing in Asia, let us go through some of the challenges that you may face during this journey to the riches. In total, there are three key challenges that you can expect while waiting for Asia Century's growth story to play out. The first is that the growth takes time to be fully captured. The second is that while the structural forces are present, there may be hiccups along the way, right? And the third is that Asia is still a developing region, and hence it is more volatile in nature. So let me explain each of these challenges one by one. Number one, the growth takes time to be fully captured. Right? For us to fully capitalize on the growth of Asia, the recommended investment duration is around 10 to 20 years, as you can see from all the projections that we've went through previously. Right? Now, while 10 to 20 years may seem like a very long time, it really isn't when it comes to investing, because don't forget, as investors, we are essentially investing in the businesses, and businesses don't often become successful overnight, right? And as what Warren Buffett says, if you don't feel comfortable in owning a stock for 10 years, you shouldn't own it for 10 minutes, right? That said, it is important that you ensure that your financial plans are aligned with your investment strategy even before you start investing, right? That way, you will be able to commit to the strategy and not disrupt it unnecessarily when you start investing. If you don't plan your finances properly and align your plans with your investment strategy, you run the risk of missing out on the potential investment gains, and worse off, you make a loss on your investments even though the strategy itself is sound. Number two, there will be hiccups along the way, right? Given that the recommended investment duration is over 10 years, there is bound to be hiccups along this journey, especially in our case where we are investing predominantly in a developing region, right? Firstly, transitions takes time and things could get ugly from time to time. Just as Rome wasn't built overnight, neither was it destroyed overnight. Certain bad practices and systems that are currently in place in the developing countries within Asia needs time to be changed. Okay? And unfortunately, these type of changes are often met with internal conflict when the countries are trying to break free from an extractive economic system to a more inclusive one. An example that you can reference from the situation that's happening in Myanmar as well as Hong Kong. Okay. Secondly, the clash of superpowers like China and US may result in an increase in tension between Asia and the rest of the world, resulting in more protectionism policies that are not trade friendly, and this is bound to hurt all parties that are involved, not just Asia alone. With regards to this point, there are two sides to the equation, right? On one hand, global trade will definitely be affected as the volume of transactions or trade between Asia and the rest of the world will decrease. On the other hand, such measures may actually be beneficial to Asia as the trade volume within Asia may increase as countries within Asia may find it more economically viable to trade with one another instead of trading with countries that have adopted protectionism policies. The last, and in my opinion, the worst hiccup that may occur is if we experience an internal conflict between the countries within Asia, and that may result in a reduced trust level and hence reducing the business activities within Asia region itself, right? Now, while all of these are potential hiccups that may slow down the growth of Asia, it will not hinder the eventual growth that is bound to happen. As long as the structural forces and the 6 key factors that we've went through earlier are in place, Asia's growth story is bound to be played out. The only unknown that we as investors face is the duration that is needed for this growth to be fully captured. Number 3, Asia is still a developing region and hence it is more volatile in nature. I think this is pretty self-explanatory. If you're someone who is investing in a developing country, don't expect to receive the type of stability that you will get by investing in a developed country, right? However, if you are investing in a developed country, don't expect to receive the return you will get in investing in a developing country, right? Higher returns are often associated with higher risk. Let me repeat that. Higher returns are often associated with higher risk. In this case, the risk that we are facing is volatility risk, also known as the price fluctuation that we will experience over the years, right? The ups and downs that comes along with the price movements. It is really not uncommon for investors to witness like a negative 10 to negative 30% in their investment values that may persist for a long period of time as a result of fear and uncertainty that comes along with the hiccups that we may experience along the way, right? In fact, from 2010 to 2014 alone, there are 5 periods of time whereby the market returned on average negative 20%, right? While from 2015 to 2021, there are also 5 periods of time where the market returned on average negative 20% to negative 30% for a long duration of time, usually spanning across 9 to 12 months before things turn for the better, right? However, if you had invested in Asia and stuck by your investment strategy for the last 10 years, your investment would have grown over 200% despite the ups and downs that you would experience over the years. Okay? In other words, volatility risk can be reduced if you have a long investment duration. Okay, let me repeat that. Volatility risk can be reduced if you have a long investment duration. Putting everything together, what does that mean to you as an investor that invests in Asia? Now, the story of the rise of Asia century is bound to play out in the next 10 to 20 years. If you are someone looking for growth and return, it is foolish for you to turn a blind eye on the developments that's happening in Asia. That being said, as an investor that's investing in Asia, don't expect the journey to be a smooth one, as there are bound to be hiccups here and there, right? Which may result in high levels of fear and high levels of uncertainty, which may cause your investments to go from positive 10% to negative 30%. These are very common, right? While volatility risk is high in the short run, as long as you are able to commit to the investment strategy and stick to it for a long duration, you can expect to see the light at the end of the tunnel as Asia transits from a developing region to a developed region by 2030 to 2040s. As what Benjamin Graham says, in the short run, the market is a voting machine. In the long run, it is a weighing machine. Okay? In the case of Asia, nobody likes a bumpy ride. Okay? But everybody knows that the weight of the Asian boat is undeniably heavy. For us as investors, the key is to not jump out of the boat during a storm, as if you do that, you are going to potentially drown, right? If you stick to the plan and ride out the journey, you will get to your destination safely and on time. As a financial steward and your financial advisor, I can assure you that. Now that covers my investment thesis as to why I am bullish towards Asia and why we should position ourselves properly to capture the inevitable growth that is bound to happen in the near future. Thanks for sticking around the entire presentation, and this information that I've shared with you over the last 30 slides is possibly one of the more important information that you ever need to know for the next 10 to 20 years of an investment journey. So take some time to truly digest what I've shared with you, and if you have any questions, feel free to reach out to me on the following platforms. Stay safe, and I hope to hear from you soon.